And we get slightly more optimistic in the markets today. Retail sales out of the U.S. coming in line with expectations. So, not really a controversial impetus there, but we do get another interesting bit of inflation data from outside the U.S., and it is once again softer than expected. We're going to get more inflation data coming at us today. And if it continues to undershoot, the question is going to have to be, why is it that global inflation is coming down faster than generally anticipated by economists? And is that as good of a thing as it sounds at first blush? This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And that is the conversation that we're going to be having today. We're going to look at what's come out here this morning with the inflation numbers that we got out of Canada. We're going to look ahead to the ones coming out from the UK later on in the next 24 hours and try to surmise what all of that means for the way forward here and whether the message in these numbers is as encouraging as it appears to be at face value. So we begin our conversation here with what happened this morning. This is Canada's CPI report here. As we can see, it saw inflation come down to 2.7% in June. That was a bit lower than expected by economists. What we were looking for was actually a hold at that 2.9% level from the prior month. As it happened, inflation undershot expectations, echoing the PMI data that we were discussing on the show yesterday as likely to set the stage for a softer result. We got that softer result here. And so what we are looking at this point is yet another central bank that has inflation data that undershot expectations. Of course, this comes in something of a sequence. We saw that last week, both U.S. and Chinese CPI numbers were weaker than anticipated, and this is now becoming a bit of a narrative. Now, in the wake of these numbers, we see that the outlook for Bank of Canada monetary policy has become more dovish. There was a shift here in the futures pricing for the number of cuts still on the menu. Now 95 basis points in further easing for the year. That's anticipated. Of course, that includes the cut that's already occurred in June, which of course then sets up the stage for another 3 cuts to happen this year. The probability that a cut is coming at next week's Bank of Canada meeting has in fact increased from 80 to 90%, according to statistics that were put together by Bloomberg. So we're looking at a situation here where the market saw a weak CPI number, nudged down the Canadian dollar a bit when the number came out. Yields fell across maturities for Canadian bonds, and the likelihood of a cut next week firmed up. So the story here, once again, inflation is lower than anticipated by economists for yet another major economy, and the specter of rate cuts has been pulled forward. for yet another major economy. The next piece of this puzzle coming up in the hours ahead comes from the UK. Here we are expecting to see that inflation has held unchanged this go around. It is seen here at 2%. That would be the same as the 3-year low that was set in May. However, if we take a look at the way that economic data out of the UK has been performing recently relative to expectations, what we find is that there's been increasing disappointment recently. And what that may very well do is set the stage for a surprise on the downside. Now, why might that be the case? Well, if we unpack what UK inflation has been made of recently, what we find is that energy continues to be the biggest sort of disinflationary force here. Of the 2% inflation recorded in May, nearly 7/10 of a percentage point. So call it 70 almost basis points of the 200 basis point reading was a downshift in fuel, essentially. Whereas the upside was mainly in discretionary spending categories, in recreation and in hospitality, restaurants and hotels. Now, what's interesting about this setup here is, of course, what this does is suggest that the remaining parts of the inflation story in the UK ought to be relatively amenable to what's going on with the business cycle, because to the extent that this is discretionary spending, it should be relatively susceptible to people tightening their belts and pulling away from sort of optional expenses, as it were, and refocusing on the essentials in any kind of an economic downturn, which of course seems to have begun already. The latest set of UK PMI data has the growth rate for the composite. This is both the manufacturing and the service sector taken together, down to a 3-month low. And again, as we've just looked at for the path of UK economic data, you can see right here, it started to weaken relative to forecasts. Now, it is above that zero line, so the tendency is still for the data to be relatively positive, given expectations, but the spread has started to weaken. And indeed, if inflation is made up at this point mainly of discretionary spending, and the economy is slowing, then you have the kind of ingredients you might look for this data to disappoint. As with Canada, of course, the implication would be that the Bank of England might be sooner to cut rates. Now, if we look at where we stand currently, the expectation is that there is on the menu basically 2 cuts. At 47 basis points here, we're looking at almost 50 basis points, or almost 2 cuts on the menu. In fact, the probability that we get those 2 cuts is implied here at 88%. If we look at the timing, we can see that the market is somewhat confounded by when the easing will begin. We can see that it's already in the market by November. So we've gone from 5.25 to sub 5%. So somewhere in here, August or September, seems like the likely time when the Bank of England might pull the trigger. In fact, in August, the probability is a formidable 64%. We can see we're already most of the way into a cut, just 9 basis points off. If this were 5 exactly, it would be a full 25 basis point reduction. As it happens, there's only 16 basis points that have already been baked in, and then 13 basis points by September. So we're, or rather 19 by September. So we're looking at the market's basically trying to nail down. Is it going to happen sooner? Is it going to happen later? And if the CPI data undershoots expectations, then of course the implication would be sooner rather than later. And we'd have yet another story where a central bank is seeing disinflation occur faster than the markets are anticipating, and thereby is being told, don't delay, start the easing cycle. As a matter of fact, this is a story that has been happening across much of the major central banks. Obviously, we've seen a rapid shift in what the pricing looks like for the Fed. The ECB has had a little bit of a wiggle to the top side here, but of course, they've already begun their rate cut cycle. The data out of Canada, as we just saw, gave us a dovish shift there. The data out of Canada and Australia is telling us that similar story. There's still no cuts expected out of Australia this year, but we can see that whereas there was even perhaps a bit of hiking speculation here at the start of July, that is giving way. So it looks like what there is, and of course we're watching what the CPI data does with this Bank of England line, the yellow one, which has been somewhat idling here, but we can see that the general thrust for this has been in the direction of a more dovish outlook for the world's major central banks. Let's call it over the past several weeks. What this lines up with, seemingly, is a downturn in global economic data. So we can see here that, according to Citigroup at least, the trend in global economic outcomes has increasingly deteriorated. Outcomes are coming increasingly worse than expectations. In fact, we can see here's that zero line. Both the numbers out of the global economy as a whole and those for the major G10 economies look very similar here, and both are now below zero, which is to say that the driving sources of demand are increasingly misfiring. The emerging market story catches up sometime later. We can see the peak in emerging markets comes after the peak in major markets and the global total, but the trend is down. There's perhaps about a month's worth of lag here, and that makes sense. A lot of the emerging markets are vendors that serve demand from the major economies. And of course, what that means is that any slowdown is likely to begin in the major economies. That, of course, is where we had the most rapid inflation, because that's where we had the most stimulus provision to combat COVID. That has also meant that that's where most of the rate hikes have been centered. So it makes sense that this would be the place where the squeeze on growth would occur first. But it also makes sense that as that squeeze tightens, there is spillover into economies that depend on that demand in order to have growth of their own. And so, with some lag, emerging markets would follow downward. So, what we're seeing here in this story about increasingly pronounced disinflation across the key economies, be it China and the US last week, or Canada and perhaps the UK this week, what we are seeing is perhaps signs of weaker demand. When prices are falling, it is not because demand is robust. It is because markets have a hard time clearing without the price coming down. That is to say, demand is too weak to soak up all of the supply at a given level of price, and so the price has to come down such that more demand is stirred up to absorb supply. And so what all of this might well speak to in the context of what's been going on with global economic data, which is to say deterioration, is the growing risk of a global downturn. The coming due, finally, of the bill on a blistering year and a half of rate hikes from the start of 2022 through about the middle of 2023 by nearly every major central bank around the world, with, of course, the notable exception of the Bank of Japan. In fact, the latest numbers on global PMIs from S&P Global suggest that June already marked the first month of deceleration in global economic activity, both manufacturing and services, in 7 months. We've seen a very clear build in the pace of global economic growth from a low in September, shock of shocks. The global stocks rally, as led by Wall Street, of course, begins at the end of October going into November, just as this bottoming is occurring. So from then and through May, the global economy is accelerating. And in June, pointedly takes a step lower. Now, if this lines up with what we've been seeing here, which is to say from about April, May, going into June, the economic outcomes have started to deteriorate. That, of course, is how you get this right here. That comes with this right here. Well, then the disinflation that we're seeing overshoot expectations, and the implications that that is having on what central banks are expected to do, which is to say, stimulate with greater urgency, cut rates more and cut them sooner, all of that seems to suggest that in unison, major monetary policy makers around the world are expected to find the economic backdrop increasingly intolerable and beckoning of action. So the story here may well be that just around the corner, we have the global downshift in economic performance that all of this tightening was feared to produce and has thus far failed to produce until perhaps the beginning of June. And if, in fact, and this is still an if, because, of course, there's still quite a bit of resilience left in markets, certainly the S&P 500 and the NASDAQ hovering near record highs does not speak to any degree of panic just yet. But markets are ever forward-looking. And if all of this repositioning speaks to some sort of elevated global recession risk now on the immediate horizon, then the positive story we've seen in global risk appetite, of course, as told with gusto by the performance of U.S. equities, that might be coming to an end sooner rather than later. And that is macro money for today. As ever, we are here right after overtime, Monday through Thursday, show that I co-host with Dylan Radigan and Chris Vecchio, looking at where Wall Street closed and what that might mean for global markets going forward. I am on the Price of Truth with Victor Jones on Wednesdays. I am on with Chris for Futures Power Hour on Fridays. Back on with Victor for First Call on Sundays, with Tom as well. Writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow. Happy trading.